Brian Quinn's here. He's not a robot. He's a real person, I promise. Starting with the big headline of the day, aren't you, Brian? The meeting between Donald Trump and Xi Jinping, aimed at de-escalating, of course, the US-China war. What sort of specifics, though, Brian, do we have on what actually came out of that meeting?
So among the top line announcements from a trade perspective, Stuart, the U.S. cutting its punitive fentanyl tariffs in half to 10%, with China promising to curb the export of the precursor chemicals for that dangerous narcotic. That reduction brings the overall U.S. tariff rate on China down from 57% to 47%. Trump's threat of 100% tariffs off the table for now. In return, Trump says that Xi Jinping agreed to a one-year renewable deal to keep Chinese rare earth minerals flowing. Recent strict export controls had threatened manufacturing supply chains worldwide. Beijing also due to resume purchases of American soybeans. Its recent boycott was a major blow to American farmers. The two leaders are set to meet again in April. As many analysts had predicted, the results are a de-escalation of the trade war, but far from a resolution. The world's top two economies remain locked in a strategic conflict over tech and manufacturing dominance. One major issue left unresolved, U.S. export restrictions on the most advanced AI microprocessors. Here's Trump on that.
We did discuss chips, and they're going to be talking to NVIDIA and others about taking chips. Look, we make great chips. NVIDIA is the leader. And I'll be speaking to Jensen from NVIDIA. We're not talking about the Blackwell. That just came out yesterday.
Trump there. What about the reaction so far in the markets then, Brian, to all of this?
Investors appearing so far relatively unimpressed with the outcome there. Hong Kong and Shanghai Chinese markets in particular in the red, with Shanghai down around 0.75% even. Some minor gains for the Nikkei in Tokyo and the Kospi in Seoul. Korean shares in particular getting a bit of a boost from the announcement of a U.S.-South Korea trade deal that will see South Korea invest $200 billion into American projects, with a $150 billion commitment to cooperation in the shipbuilding sector. Here in Europe, only the DAX in Frankfurt opening in positive territory, both London and Paris losing some ground. Analysts say that with no concrete resolutions on the sale of TikTok's American operations and plenty of tariffs still in effect, the details released so far represent a fairly limited de-escalation.
I think China has its own cards to play, right? The rare earth and other things, and US also has its own card. But looks like both parties are kind of in a negotiation sort of mode. So that looks like both parties don't actually want to make things worse.
Investors, though, are likely cheering the latest policy decision. This is from the US Federal Reserve, Brian.
America's central bank, Stuart, lowered interest rates once again on Wednesday. That decision coming in spite of inflation that remains above the Fed's target, as policymakers try to provide some support for the U.S.'s increasingly shaky labor market. The quarter-point cut brings the bank's benchmark rate to its lowest in 3 years. Officials there, though, acknowledged that they're flying blind as the ongoing U.S. government shutdown has deprived them of an entire month of employment data. Rachel Griffiths has the details.
It's the second time this year that the Federal Reserve have lowered their interest rates. In a meeting that highlighted growing divisions among its ranks on Wednesday, policymakers voted 10-2 in favor of lowering the bank's key lending rate to between 3.75% and 4%. The chairman said that financial markets should not assume an interest rate cut will happen at the end of the year.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
The Fed also announced that it would soon end its policy of shrinking the size of its balance sheet, which ballooned during the pandemic. Due to the ongoing government shutdown, delays in key government official economic data made the job more difficult for policymakers. They remain divided over how President Trump's sweeping policies on trade, immigration, and spending are affecting the U.S. economy. Major companies such as Amazon and Target have recently announced tens of thousands of layoffs. Fed Chair Jerome Powell warned last month that the combination of rising layoffs and weak job growth could very quickly flow into higher unemployment.
And as we're speaking of AI chips there, Stuart, it's worth pointing out that a very significant percentage of the U.S.'s economic growth in the recent quarters have been due to AI capital expenditures. That's got to be on the Fed's mind as well.
Indeed, I'm sure it will be. Brian, thanks very much, Brian.